I'm going to try and say some words on the things I've used over the years when I was an amateur, when I ran Magellan, I still use today. I think they make sense. I think they make a lot of sense for investors. And I frankly think it's a tragedy in America that the small investor has been convinced by the media, the print media, the radio, the television media, that they don't have a chance. That they don't, the big institutions with all their computers and all their degrees and all their money have all the edges. And it just isn't true at all. And when they're convinced, when this happens, when this occurs, people act accordingly. When they believe it, they buy stocks for a week, and they buy options, and they buy the Chile fund this week, and next week it's the Argentina fund, and they get results proportional to that kind of investing. And that's very bothersome. I think the public can do extremely well in the stock market on their own. I think the fact that institutions dominate the market today is a positive for small investors. These institutions push stocks on usual lows, they push them on usual highs. For someone that can sit back and have their own opinion and know something about industry, this is a positive. It's not a negative. So that's what I want to talk about. And the single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. And that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks. And this is the kind of stock people like to own. This is the kind of company people adore owning. It's a relatively simple company. They make a very narrow, easy to understand product. They make a 1 megabit SRAM, CMOS, bipolar risk, floating point data I/O array processor with an optimizing compiler, a 16 dual port memory, a double diffused metal oxide semiconductor monolithic logic chip,
2,000 years later.
peripheral bus architecture, 4-wave interleave memory, a token ring interchange backplane, and it does it in 15 nanoseconds of capability. Now, if you own a piece of crap like that, you will never make money. Never. Somebody will come along with more whetstones or less whetstones or a bigger mega flop or a smaller mega flop. You won't have the foggiest idea what's happened. And people buy this junk all the time. I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, I can understand it. And you laugh, I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports, they buy a microwave oven, they do that. They ask people what's the best kind of radar range or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the mobile travel guide, or California. When they go to Europe, they get the Michelin travel guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it. And that's what we're being driven to, and it's self-fulfilling. The public does terrible investing, and they say they don't have a chance. It's because that's the way they're acting. I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, I had logic, so I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. So what I'm trying to tell you, it'd be very useful to know what the stock market's going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rate's going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that. Now, I have to be fair. I'm talking about economics on the broad scale, predicting the downturn for next year, or the upturn, or M1 and M2, 3B, and all these M's. I'm talking about economics. To me, is when you talk about scrap prices. When I own auto stocks, I want to know what's happening to used car prices. When used car prices are going up, it's a very good indicator. When I own hotel stocks, I want to know hotel occupancy stuff. When I own chemical stocks, I want to know what's happening to the price of ethylene. These are facts. If aluminum inventories go down 5 straight months, that's relevant. I can deal with that. Home affordability, I want to know about when I own Fannie Mae, or I own a housing stock. These are facts. They're economic facts, and there's economic predictions. And economic predictions are a total waste. And interest rates, Alan Greenspan's a very honest guy. He would tell you that he can't predict interest rates. He can tell you what short rates are going to do in the next 6 months. Try and stick them on what the long-term rate will be 3 years from now. They'll say, I don't have any idea. So how are you, the investor, supposed to predict interest rates if the head of the Federal Reserve can't do it? So I think that's, but you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine. And you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. So I think that's the key to element. Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor. You're not sure this Walmart can make it. You want to check. You see them operate in small towns. You're afraid they can only make it in 7 or 8 states. You want to wait till they go to more states. You keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money. But you could have waited 10 years after Walmart went public and made over 30 times your money. You could have waited 3 years after Microsoft went public and made 10 times your money. Now, if you knew something about software, I know nothing about software. If you knew something about software, you would have said, these guys have it. I don't care who's going to win, Compaq, IBM. I know who's going to win Japanese computers. I know Microsoft, MS-DOS is the right thing. You could have bought Microsoft. Again, I'm repeating myself. Stocks are not a lottery ticket. There's a company behind every stock. And you can just watch it. You have plenty of time. People are in an amazing rush to purchase a security. They're out of breath when they call up. You don't need to do this. You need an edge to make money, too. People have incredible edges, and they throw them away. I'll give you a quick example of SmithKline. This was a stock that had Tagamet. Now, you didn't have to buy SmithKline when Tagamet was doing clinical trials. You didn't have to buy SmithKline when Tagamet was talked about in the New England Journal of Medicine or the British version, Lancet. You could have bought SmithKline when Tagamet first came out, a year after it came out. Let's say your spouse, your mother, your father, you were a nurse, you were a druggist, you're writing all these prescriptions. Tagamet was doing an amazing job of curing ulcers, and it was a wonderful pill for the company because if you just stopped taking it, the ulcer came back. See, it wouldn't have been a crummy product that you took it for $1 and it went away, but it was a great product for the company. But you could have bought it 2 years after the product was on the market and made 5 or 6 times your money. I mean, all the druggists, all the nurses, all the people, millions of people saw this product, and they're out buying oil companies, or drilling rigs, It happens. And then 3 years later or 4 years later, Glaxo, even a bigger company, it's a huge company, a British company, brought out Zantac, which was a better, at that time, an improved product. And you could have seen that take market share, do well. You could have bought Glaxo and triple your money. So you only need a few stocks in your lifetime. They're in your industry. I think of people, if you'd worked in the auto industry, let's say you're an auto dealer the last 10 years, you would have seen Chrysler come up with a minivan. You've seen, if you're a Buick dealer, a Toyota dealer, a Honda dealer, you would have seen the Chrysler dealership packed with people. You could have made 10 times your money on Chrysler a year after the minivan came out. Ford introduced the Taurus Sable, the most successful line of cars in the last 20 years. Ford went up 7-fold on the Taurus Sable. So if you're a car dealer, you only need to buy a few stocks every decade. When your lifetime's over, you don't need a lot of 5-baggers to make a lot of money starting with $10,000 or $5,000. So in your own industry, you're going to see a lot of stocks, and that's what bothers me. There are good stocks out there looking for you, and people just aren't listening, and they're just not watching it. And they have incredible edges. People have big edges over me. They work in the aluminum industry. I see aluminum industries coming down, inventories coming down 6 straight months. They see demand improving. And in America today, it's hard to get an EPA permit for a bowling alley, never mind an aluminum smelter. So when aluminum gets tight, you just can't build 7 aluminum smelters. So when you see this coming, you can say, wait a second, I can make some money. When an industry goes from terrible to mediocre, the stock goes north. When it goes from mediocre to good, the stock goes north. And it goes from good to terrific, the stock goes north. There's lots of ways to make money in your own industry. You can be a supplier in the industry. You can be a customer. This thing happens in the paper industry. It happens in the steel industry. It doesn't happen every week. But if you're in some field, you'll see a turn. You'll see something in the publishing industry. These things come along, and it's just mind-boggling. People throw it away. One of the things I find a couple of rules I want to throw out that I find useful, excuse me, is a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100. People said, "Here's this great company, great record. If it ever gets below 100, just buy every share." And it did get below 100. A lot of people bought on that basis, saying, "Look, it's gone from 135 to 100. It's now 95. What a buy!" Within a year, it was 18. And this is a company with no debt. I mean, this is a company that was just so overpriced. It went down. I did the same thing in my, I think my first or second year of Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, how much lower can it go? It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange at Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now I am fortunate this happened rapidly, or I would probably be still caddying or being working at the Stop and Shop, but it happened fast. So I was able to, it was compressed. And at 3, I figured out, there's something very wrong here because Kaiser Industries owns 40% of Kaiser Steel. They own 40% of Kaiser Aluminum. They own 32% of Kaiser Cement. They own Kaiser Broadcasting. They own Kaiser Sand and Gravel, Kaiser Engineers. They own Jeep. They own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement. But they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, there's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, everything's fine, and eventually this will work out. And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement. They passed out shares in Kaiser Aluminum. They passed out their public shares in Kaiser Steel. They sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16, and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do? It's psychiatrists that haven't worked so far. I've never seen them running in. the psychological psychiatry fund I've never seen listed for with the SEC to make it through as a mutual fund. So they haven't seemed to help. I've tried prayer, that hasn't worked. So if you don't understand the company, you have this problem when they go down. Eventually, they always come back. This one doesn't work either. People think RCA just about get back to its 1929 high when General Electric took it over. A lot of double knits never came back. Remember those beauties? Floppy disks, Western Union. The list goes on and on. People saying it'll come back. Well, it doesn't have to come back. Here's another one you hear all the time. It's $3. How much can I lose? I've had people call me up saying, I'm thinking of buying this stock at $3. How much can I lose? Well, again, you may need a piece of paper for this, but if you put if you put $20,000 in a stock at 50, or your neighbor put $20,000 at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money, everything. And people say it's 3. How much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. And in fact, short sellers, people that really make money in stocks, they don't short Walmart, they don't short Home Depot, they don't short the great companies, Johnson & Johnson. They short stocks down from 80 to 7. They'd like to short it at 16 or 22, but they figured out at 7 that this company is going to go to 0. They just haven't blown taps on this thing yet. It's going to 0. And they're selling it short at 7, they're selling it short at 6, at 5, at 4, at 3, at 2, at 1.25. And you know, to sell something short, you need a buyer. Somebody has to buy the damn thing. And you wonder, who's buying this thing? It's these people saying it's 3. How much lower can it go? You know, the important thing is you can't get too attached to a stock. You have to understand there's a company behind it. You can't treat this like your grandchildren. You know, you have to deal with the stock and say, I understand the company. And if it deteriorates, if the fundamentals slip, you have to say goodbye to it. If one rule you want to remember is the stock does not know you own it. This is a breakthrough. So don't get, you have to understand it and say they're doing well, and as long as they keep doing well, my best stocks have been my 5th, 6th, 7th year I own them, not my 5th, 6th, 7th day. So you have to understand that and stay with it. And then I'll switch through to my long shots. Avoid long shots. I bought about 30 long shots in my life. I've never broken even on one. The ones that are really bad are what we call whisper stocks. And if Arthur Levitt was here, he'd appreciate these stories. But these are the kinds that somebody calls you up and say, hi, Peter, how's Carolyn, how are the kids? And I'd like to talk to you about International Blivet. And what they have in this company is very good about the earnings. Earnings going to be very, they're going to be big, small. It's $3, $1 a share. And they keep whispering, and they say, what are you talking about? I don't understand it. And these are, now, either they're so surrounded by people that are going to run out and buy this stock because it's so exciting, or they think the SEC is listening in. They'll get a shorter term. They'll get 6 months in the camp rather than 2 years in the camp. But whisper stocks don't work. And then I want to conclude with there's always something to worry about. If you own stocks, there's always something to worry about. You can't get away from it. What happens in the 50s, people were worried about the only reason we got out of the Depression was World War II. We got another recession in the early 50s. They said we're going to go right back into a depression. People were worried about a depression in the 50s, and they worried about nuclear war. I mean, back then, the little warheads they had then, they couldn't blow up McLean, West Virginia, or McLean, Virginia, or Charlestown. Now, all these countries that end in STAN, there's 9 of these STAN countries that have come out of Russia. They all have enough warheads to blow the world up, and no one worries about it. When I was a kid, people were building fallout shelters, and we used to have this civil defense drill. Remember this one in high school? You get under your desk. I never thought even then that was a particularly good thing to do. If it blow was somebody put on a hat, we'd all get under our desk. But in the 50s, people wouldn't buy stocks, except for the 80s. The 50s was the best decade, the century of the stock market. And people wouldn't buy stocks in the 50s because they're worried about nuclear war and they're worried about depression. Then people, remember when oil went from 4 to 40 and it was going to go to 100 and we're going to have a depression? Remember that one? Well, about 3 years later, the same experts, now higher paid, oil's now at 10, they said it was going to go to 4 and we're going to have a depression. And then the Japanese, remember how the Japanese were going to own the world? Remember that one? And that we're going to have a depression? And then about 2 years later, we're all worried about Japan collapsing. And this is the most absurd thing I've ever heard. There's a company with a 20% savings rate, incredible workforce, incredible productivity, and people were saying we're going to have a depression because Japan's going to collapse. And they had on their prayer list, they load Mother Teresa and crippled children, and they were praying for Japan at night. It's unbelievable. I mean, the LDC debt. Remember the LDC debt? Remember that one? All these countries, all Chase had lent their net worth to Brazil, Chile, Peru, and all these other countries, and so and all the other countries. And LD said they were not going to pay it back, and we're going to have a depression. It always ends, and we're going to have a depression, or the Great Depression. We're going to have the Great Depression. I never could understand that adjective in front of depression, but the Great Depression, or the big one. The big one's coming. But all these countries, and now I understand, these are called then they were called less developed countries. Now, we used to call them underdeveloped countries. Those are all wrong terms. Those are not politically correct. You have to call these emerging countries. You can't use less developed or underdeveloped because that's, in fact, the other day I heard the politically correct term for somebody that's overweight is laterally challenged. That's so there's always something to worry about. And the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever cared what was under the damn curve? I mean, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see, it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well. And that's all there is. And I'm ready for questions.
Okay, thank you very much. When managing a portfolio, do you pay much attention to the activities of Congress and the regulators?
Did Ed Markey put this one up? I'm not sure. I spend zero time thinking about what's happening down here in Washington. And I spend little time thinking what's going on in Russia or China. I just deal with facts. When the economy's going down, when the economy's going the wrong way, I can deal with that. This whole health care reform bill drove a lot of drug stocks down to low levels. And I could say to myself, well, 60% of Johnson & Johnson's earnings are outside the United States. Their pharmaceutical drug business is all on patent. Nothing's coming off patent. They only have 5% of sales from one product, which is Tylenol, which is already an over-the-counter drug and it's growing overseas. I says, why is this stock gone from 58 to 36? And these companies are already dealing in Japan and overseas with they already have the government controlling pharmaceutical prices. They've dealt with it. So I deal with facts. They might, this year, I thought it was very likely you'd have a bill passed on healthcare. It didn't happen. They drove the stocks down, but I think the stocks would have rebounded anyway, even if the healthcare bill was passed. So I don't deal with what's happening in Congress or what's going to happen in the future. I just deal with what's happening in the economy and what's happening in the companies I call.
Thank you. How useful is the financial reporting in the general daily press to you, and how useful should it be to investors in general?
Okay. It has improved dramatically, not just in the press, but also company reporting. 10 years ago, companies didn't have interim balance sheets. It's hard to imagine. They only gave their balance sheet to you once a year. Now they show you quarterly what's happening in their inventories, what's happening in receivables. In the major newspapers, they'll even show types of funds. They're now, I think there's 2,500 companies in the New York Stock Exchange. There's over 5,000 different mutual funds. So there's twice as many mutual funds as there are stocks. At least in the paper day explains what kind of fund this fund is. So I think reporting has improved. They report earnings. But again, I think if you own auto stocks, you shouldn't be reading the financial part of the newspaper. On Wednesday, the local newspaper, Tuesday, some places, or on Saturday, they have a whole 4 pages on automobiles. And they talk about new models. And they say this one stinks and this one's outstanding. They really, if you own auto stocks, that's the part of the newspaper you should be in. You shouldn't be calling your broker 4 times a day to get stock quotes. It doesn't work. Getting up in the morning to look to see how your stock did yesterday is not useful. It's all this stuff is just a waste of time. If you're adding up how much your stocks are worth, absolute waste of time. You should be looking at the company when you get the quarterly reports. You should be, if you're at the mall, imagine if you were in the retailing industry, or if you're in the restaurant industry, you would have seen Taco Bell, you would have seen McDonald's, you would have seen Toys R Us. I mean, you would have seen all these companies do terrifically well. You would have seen Bombay, you would have seen Tandy with Radio Shack, and you would have seen Radio Shack roll across the country, and pretty soon there were, 25 Radio Shacks in every major city, and you said, there's not much room for them to go. But they had a 20-year great run. That's what you're dealing with. You're not dealing with the minutia of today. You're dealing, what's this company doing 2 years, 3 years, 4 years, 5 years from now? And if you're dealing with a cyclical and business is turning around, you wait for signs that business is slowing down. When you see it, you move on to something else.
Are you concerned about the volatility in the financial markets today, do you think something needs to be done to reduce it?
I love volatility. I think I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept onto it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola. And I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out mutual funds they own, and keep adding to it. Basic corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will follow. That's all there is to it. October has always been a special month. I remember in 1987, I was very, I was very convinced the market was not in trouble, and I didn't worry about things. And Carol and I had planned this great golf vacation to Ireland, and we're going to visit one course and stay at a little house and visit another, go all along the west coast of Ireland and play golf. And we left on a Thursday night, and the market went down 55 points that day, which was not too good. And the next day we got to Ireland, because of the time difference, we completed our day, and I got back to the hotel and I called in. The market had gone down 112 on Friday. I said to Carolyn, I think if the market goes down on Monday, we're going to have to go back. And so we stayed there for the weekend. And on Monday, the market went down 508 points, and my fund went from, I think, 12 billion to 8 billion. And that gets your attention, in two working days. I said, at the end of this week, I'd be, have no fun. Now, there wasn't a lot I could do. I mean, here I was on Monday, because the market didn't open, by 12 o'clock, it was in Ireland, it was still 7 o'clock in New York. So we did spend that day, and we played around golf in the morning, and then we went somewhere and sort of watched the market deteriorate. And I did come back. There wasn't nothing I could do. I mean, just nothing I could do about it. But I think my shareholders, they called up and they said, well, what's Lynch doing? They said, well, he's on the 6th hole, and he's, he's even par up to now, but he's in a trap. This could be, this could be a triple bogey here. This could be a big inning. And I don't think that's exactly what they want to hear. So I could do something about this damn thing. So I came back home and suffered with everybody else. And fortunately, I was very consistent. The market went down. When I ran Magellan on 13 years, the market went down 9 times. And every time the market went down, Magellan went down. I was 9 for 9. And, because it's very important. It's another one of these numbers you ought to write down. If you put $1,000 in a stock, all you can lose is 1,000. I've done that several times. And but if you're right, you can make 5,000, 10,000, 20,000. So this business, you don't have to be right 1 out of 2 times. You can be right 1 out of 4. It's a long time. The times you're right, the company's doing well, they're doing a great job, and you add to it, or at least you don't sell it, which is a terrible tragedy. So you can make more money on the upside. So I just wrote those out, and I will now flip a coin to tell you where the market will go to 4,000 this year or next year. Heads means it goes up. It's a 2-headed coin. The market will go up in the next year. That's all I ever know about the stock market.
This questioner intends to put $1,000 yearly into my 4-year-old daughter's education fund. Where should I put it? Investment 1. The other just covers everybody else. What are some of your current market favorites, and why?
Well, on the first one, and this is important whether you're investing for a 4-year-old, a 14-year-old, or a 74-year-old. You have to say, what am I going to do when the market goes down? Because I've had audiences like this, larger audiences, and I'll say, how many people in the room are short-term investors? I've never had anybody ever raise their hand. I mean, everybody in the world is a long-term investor until the market goes down. And like in I remember 1990 was so much scarier than 87. 87, the market just fell down. And you call up companies and said, our business is terrific. We're about to announce a stock buyback. We're already buying back our stock. Business is great, and we can't figure this out. But in 1990, you had Kuwait invaded. You had the banking system really on the ropes. I mean, really close. You call up a company and said the business was slowing down. We sent 500,000 troops to Saudi, and we were about to fight what people thought was remember this was it was the fourth largest army in the world, and they were the toughest army in the world, and this was going to be a terrible war, and that we ought to sit them out. Remember the theory, big theory, there's a lot of people in this city saying, we ought to wait them out. You know, we'd still be waiting there at 120 degrees with our 500,000 people. I mean, I think Bush made an incredibly brave decision on the information he was getting to go in there and knock them out, or we'd still be there. But that was an ugly time, and that was very scary. And the public stood up. Some people learned from 87, and they stood throughout that and said, I'm confident about the next 5, 10, 15 years of this country, and they hung in there. So I would say if you want to buy a small growth fund, or you want to buy a balanced fund that's part bonds and part stocks, you can put so much money in, put more in every year, you'll be very pleased in 10, 20, 30 years. Stocks will beat the hell out of money markets. They can beat the hell out of bonds. No group of, you think of it, any corporations, McDonald's, any of these great companies, Marriott, you name it, they've never got together and said, geez, you know, we're really doing well. Why don't we raise the coupon on our bonds? You know, those bond holders have been really loyal. We've been given 8%. Why don't we raise it to 9%? But companies like automatic data processing, they do payrolls, amazing prosaic company, 32 years of higher earnings, 32 years of double-digit earnings growth. We've had recessions, we've had wars, we've had changes in Congress, changes in the Supreme Court, 32 years of up earnings. So, I mean, that's what you're relying on. Johnson & Johnson, 30 years of up earnings. I mean, these are General Parts, 42 years of up earnings. Emerson Electric, 38 years of up earnings. You don't see companies like this in other parts of the world. So I think that's what you buy when you buy a fund. You're buying a bunch of good companies. The decade of the 80s, this is what you hear from the press. This is what you hear from TV. In the decade of the 80s, the 500 largest companies eliminated 3 million jobs. 3 million jobs. But there was 2.1 million businesses started in the 1980s. And if they just have 10 people each, that's 21 million jobs. It's an incredible job machine we have in America. So that's what happened in the 80s. These 2.1 million businesses created all the jobs. And the decade of the 90s, the top 500 companies are going to eliminate another 3 million people. And all you ever hear about is Company X lays off 5,000 people in Hartford, Company Y lays off 5,000 people in Rochester, and somebody doesn't buy a sofa in Scottsdale, Arizona, because they're reading their newspaper about another layoff in the Northeast. I mean, that's the nature. These companies have to do it to stay competitive. That's our business. And we've had, in the last 2.5 years, been a phenomenal, this has been a great thing for our country. We've had 1,750 companies come public. They've raised over $100 billion. There's only 2,500 companies in your stock exchange. 1,750 companies is a lot. They're going to put this into research and development. They're going to put it into more plant, more efficient equipment. This is a fantastic thing for these companies. So I think the situation is excellent. The banking system, for the first time since the early 50s, a lot of people follow the banking industry. The banking system today has more investments on the left side of the balance sheet. You talk about the governments they own, the mortgage-backed securities they own, than they have loans. First time ever since 1951. And they're only making 50, 20, 30 basis points. They said, love to make loans. The banking system has the highest equity to assets in 45 years. The banking system is ready to go. There's lots of liquidity around. I don't know why people are so depressed about people getting hired all the time. I can't quite figure this out. I don't know. I have never met a banker, anybody in business that likes recessions. I've yet to find these people, So I think it's very good the economy's doing well. But seriously, I think it's very important that people understand when they own a bond fund that bonds can go up and down. Bonds are just about as volatile as stocks. And if they own a 30-year bond fund, that you can lose 25, 30% of your money very fast, even though they're government bonds. People have to understand this. There's an incredible rate of illiteracy in our public, and all they ever hear about is what happened today to Bristol Myers going up $2 or $3. What happened to Dow Jones? They don't get to learn anything about America. And people at some point in their career are presented, they're near retirement, they're given $450,000, $500,000 because it's an early retirement. They have no experience. They don't know what a bond is. They don't know what stocks are. They have to make a decision in 30 or 60 days or they have a big tax consequence. These people have had no experience learning about the stock market. It's a tragedy. So I think anything we can do to educate the public, If you can convince people, if they understand the volatility of the stock market, I'm not saying anybody should buy a stock. I'm just saying if you purchase a stock, you ought to do certain things. If you purchase a stock and do certain things, you will do better. If you're not ready to do those things, you should keep your money in the bank. Keep your money in a money market fund. Some people aren't willing to do the homework. They don't have the stomach for it. They should stay out. They're not doing anybody any good by taking half their life savings and putting in the stock market. Or they've been lucky enough to save $50,000 or $60,000 to send their kids to college, and one's going to start in a year, and they're going to take all that money and put it in an equity mutual fund with a 1-year horizon. That's doing no one any good. So I think the more, whether it's the banks that explain it, the brokers that explain it, anybody that does, and we're working on this at the SEC is working very hard on this to explain to people the nature of these products. If they understand them, they'll do better with it. More information. Fidelity's launching a major study. It'll be out the end of this year on retirement. We've interviewed over 1,600 people, over 300 experts. We're going to put a major study on, trying to explain to people about nature of retirement and how they can best understand how they should invest their assets. We're not going to mention Fidelity at all, of course. It may be subliminal in it, but we're trying to help. And the more we can do this, and there's been an incredible push by the SEC to do this, I think it's a very positive element. I think you have to be careful in crossing the bridge on how much we get involved in managing companies. I think there should be disclosure of what people are getting paid. There should be disclosure of how many shares they own. But I don't think we should be deciding whether they should make this acquisition or whether they should expand this plant. When you get too involved in running a company, it's very complex. And a lot of great companies have made a lot of decisions you haven't heard about because they decided not to do something. Some of the best decisions they didn't do was to not do something. And if they're under all this pressure from shareholders of what to do and what not to do, they're going to take their eye off the ball and they're not going to be able to run the business. And companies are doing well because the companies do well, look out 5, 6, 7 years, and some of the decisions they make may not be the right thing for the next year. The more and more we concentrate on what they're doing and we keep commenting on as outsiders, it's going to be run by an enormous committee and we'll get committee results. So I don't think that's going to help anybody. But disclosure of relevant facts, of how many options people have, or the options at the market, what they're being paid, I think that's important, how many shares they own, what the company's doing. I think they used to not have a letter. I mean, it's not that recently that you have comments by the chief executive at the stop and end report. They never used to have to make that. There's a letter saying what happened. I mean, it really is a very valuable piece of information. You don't realize this company spent a lot of time on this. This is a very serious document. I think it's very helpful to shareholders. The quarterly shareholder reports are excellent. And also, I've stressed, everybody in America can get a hold of a company. It's not Fidelity and Putnam and Dreyfus. You can get a hold of a company if you own 100 shares. You can call a company, somebody will talk to you about it. People don't take advantage of that. These companies are willing to talk. On this quantitative and qualitative risk ratings, I think if it could be done, I think it might be possible. I'm a little confused on it. I'm not that up to date on it. But I think people should understand, that certain stock funds, emerging growth funds that invest in companies that have 50 million or sales, and very small and much more volatile than when you're buying major quality blue chip growth companies. And that long-term bonds are more valuable than medium-term bonds, which are more volatile than one-year bonds. I think these are things that should be explained to people. People should get a menu like you get at Howard Johnson's. I always look at the stock market. I think of it more, if people study chess, this would be not a good game to study for the stock market. Because in chess, an outstanding player will beat a good player 1,000 times in a row. Everything's in front of you. All the moves are known. It's all technique. In poker or in bridge, there's a lot of uncertainties. There's a lot of things you don't know. You can play a hand exactly right and lose. You say, but I played it right. If I do it again over a night, over a month, I'll do it. That's the stock market. The stock market is much closer to poker than it is to than any other game. And I think that's what's the important thing to know. So all these things, if you keep watching the story, every year you get a chance to buy this again. Something will come up.
Here's a fella has a problem. He says, well, if the real secret of your success is following your daughters to the shopping mall for stock tips, what do we bachelors do?
Well, I think on the weekend, I think one of the reasons people get so depressed is they get away from children. On the weekend, they read all these magazines, they read the newspapers, and they can become economists and they get so depressed. I mean, they're bullish if they take their lunch to work on Monday, And I think you need to rent a 12-year-old on the weekend just to, because they don't know about the problem of the ozone layer disappearing and all the problems of, all these terrible things that we think about all the time. You get so depressed about, and how second basemen and shortstops that getting paid $4 million and they can't throw it to first base on a bounce. So I think you need to find a 12-year-old and rent them for the weekend and follow this boy or girl around and see where they're shopping. And our kids love Body Shop, and I bought it, and I think it's gonna be a good stock. And our oldest daughter, Mary, liked Ann Taylor, and she had to dress up to go to work she was working this summer at a consulting firm, and she thought Ann Taylor's prices were good and the quality was good, and it was a great stock pick. And my wife, Carolyn, who is till we had these 3 kids, she's an extremely good shopper. She almost got a black belt in shopping. She didn't fit because of the children. She didn't quite finish that, but she's a very good shopper, and she's given me some great tips too. So I think you either have to use your spouse, or you have to go out on your own. I had this biggest position. My fund one time was Hanes, which owned Legs, and was a huge stock, and it was bought eventually by Consolidated Foods, and it was the best division of Consolidated Foods. But it's my biggest position. They had a monopoly on this Legs. Legs is a really big hit. I knew somebody would come along with a new product, and it was Kaiser Roth introduced No Nonsense. I was worried that this thing was better, and I couldn't quite figure out what was going on. So I went to the supermarket, and I bought 62 pairs of No Nonsense, different colors, different shapes. They must have wondered what kind of house I had at home when I was going back. But I brought it to the office, and I passed out to anybody, male or female, anybody wanted these things. Just take them home and tell me how it is. And they came back in about 3 weeks, and they said, it's not as good. And that's what research is. That's all it was. And I held on to Hanes, and the stock was a huge stock. So that's what it's about. Thank you. Thank you. Thank you. Thank you. Thank you.
We're in a huge hole. Horrific. All this is going to collapse. The dollar is going to lose its reserve currency status.
Are we headed towards a recession that's going to be worse than 2008?
I think so. In fact, I think we're actually in recession. By the time they write the history books on this era, it may be considered a depression. I think that the numbers that we get from the government are not accurate by design. So I don't really think that the economy is growing in any real sense. The way they compute the numbers, I think, is deceiving. For most Americans, their standard of living is declining. I don't think the economy is really getting bigger. I think we're spending more, we're borrowing more and going deeper into debt. We're paying more for everything we buy. And a lot of that consumption ends up feeding into the GDP. And so we get a bigger GDP number and we think, oh, that means the economy is growing. But I think it's all being distorted by the inflation and the debt. Meanwhile, individuals that are living in the economy are struggling. Their cost of living is going up. You have a record increase in the number of people holding multiple jobs, not just 2 jobs, but 3 jobs or more. And they still can't make ends meet. You've got record credit card debt, which is now over $1 trillion, first time ever. And we almost have $2 trillion in student loan debt. I mean, that has just exploded. And all sorts of debt. If we really had a growing economy, people would be getting out of debt. That's what happens when you're doing well. You pay off your debt. You build up your savings. The savings rate has collapsed in the last couple of years. That's not a sign of economic strength. That's desperation. People are tapping into whatever savings they have left just to make ends meet. We have record budget deficits. If times were good, the government would be running smaller deficits. They would be collecting more taxes. They wouldn't be spending as much on, government assistance. Our trade deficits are at record highs. If we had a booming economy, we'd be making more stuff. We'd be exporting that stuff, or we'd be importing less because we would just consume what we produced ourselves. But our economy is really shrinking. And that's why we're on life support. We're dependent on foreigners for all the goods that we can't produce. And we have to pay for it on credit because we don't have the real incomes or the savings to afford it.
The economy works in a certain way. There are physics to it. So what is it that you see that makes a recession or depression happening now or inevitable? What do you see that they're missing?
Yeah, first of all, I don't think we're in a depression now as far as the economic conditions. I said that by the time the historians look back on this time period, this could be the beginning of that depression, because I think the depression is in our future, really not in our past. And the way we've been kind of holding back the tides of depression is through debt and inflation. And so we've been kicking the can down the road, but we're really sowing the seeds of the future depression that I believe the time period we're in now will just be lumped in with it. This is the earlier stages of that prolonged period that is really going to coincide with having to come to terms with all the mistakes that we've made in the past. It's like the chickens coming home to roost because of bad monetary and fiscal policy that go back for decades. We're in a huge hole. It isn't going to be easy to get out of it. And the time period where we're going to get out of it, it's going to be hard times. And the government is in a position to make those times a lot harder. That's a wild card as to how the government is going to react to this unfolding crisis and how much worse they might make it be. Now, as far as hyperinflation, I was talking about a hyperinflation scenario back in the early days of the 2008 financial crisis based on the way the government reacted to that with quantitative easing. And I knew the road that we were going down could lead to hyperinflation. Now, I always said that that was a worst case scenario. I never said, hey, it's for sure. I still think that that hasn't been taken off the table. The odds of that are actually greater now than they were when I first started warning about it. But I always said that, look, that's the worst case scenario. You destroy your currency completely, where you're talking Weimar Republic, Zimbabwe. But what I did say was inevitable was very high inflation. And we've just started to experience that in recent years. And I don't think that's over. I mean, I think we're going to see higher inflation. Right now, the high watermark for year-over-year CPI was just over 9%. That's not going to cap this. We're going to go into the double digits. And the first digit might not be a 1. That still wouldn't be hyperinflation, right? If we have 20% inflation, that's not hyperinflation.
That's curl up in a fetal position and suck your thumb and cry yourself to sleep territory.
It's bad, but also if you compare what we have now, because everybody wants to say, look, it's not that bad because look how much worse it was in the 70s where we had inflation 10, 11, 12% for several years. What people don't understand is that you're comparing apples to oranges because the CPI that was in use in the 70s is not the same CPI that we use today.
What does it mean to quantitatively ease a situation? Why does that become problematic? And that is the most important seed that sows your destruction in terms of inflation.
When they print their way out of a short-term problem, they print their way into an even larger long-term problem, which is what they did. Now, quantitative easing is just a euphemism, better sounding name for something that's really bad, which is inflation. Quantitative easing is when the government prints money and buys government bonds. Now that's inflation by definition, by classic definition. Inflation is when you expand the supply of money. How is the money supply expanded? By the purchase of debt. The central bank buys government debt and creates the money to pay for it. That's the mechanism in the United States where the money supply grows. And so that's just inflation. When Ben Bernanke first launched quantitative easing in 2009 as a way to stimulate the economy, he really said, look, let's create a bunch of inflation to stimulate the economy. Now, he didn't want to say that because if he went out and told the public our solution to this financial crisis is to create inflation, people would have said, but wait a minute, I don't want inflation. I don't want my cost of living to go up. That doesn't sound like a good solution. Is that all you got? You got something else? Basically, they dress it up and they say, no, what we're doing is quantitative easing. That doesn't sound so bad. That's how they got the public to swallow more inflation. The reason that we didn't get real big increases in the CPI until really after COVID was that there were a lot of forces in the economy at that time that were pushing prices down. And had the government not unleashed all this inflation, we would have seen prices fall. I mean, they never actually fell during any year. But had the government not done that, I'm pretty sure that prices would have gone down and the cost of living would have been lower. Now, a lot of these politicians or Keynesian economists say that's terrible. Oh, that's deflation. That's really a bad deal. We don't want that. That's BS. If prices go down, that is good for the consumer. That provides relief because now the cost of living is lower. You don't need as much money to buy food. You don't need as much money to buy energy. You have more money left over to buy other things. You don't have to go into debt to pay for things. And falling prices is even good for business. As long as their costs are falling in line with their prices, they maintain their margins and now they can sell more. They make it up on volume because when prices are lower, their customers can buy more stuff. So everybody wins from falling prices, but the government doesn't want that. It was able to stop that by unleashing inflation.
The government actually does want falling prices because they want to tax that falling price in the form of inflation. But if they don't have the falling prices, when they do inflation, people will really feel it. So for instance, if prices were actually going down by 2%, they inflate by 3%, they now get 5% inflation, but I only feel 3% of it. As the government, I'm able to really take advantage of those falling prices.
You hit the nail on the head, and I'm glad that you actually picked up on that. Inflation is a tax, and people just don't realize it because the government blames it on greedy corporations, on Putin, on OPEC, on everybody but themselves. But it is a hidden tax, and the easiest way to hide it is if you have a productive economy that otherwise would reduce prices. Because if prices were going to go down, let's say by 5%, and they create 5% inflation so that prices remain the same, nobody realizes how much worse off they are because the government stole something they never had. The free market was going to deliver that benefit, and the government took it. See, what everybody has to understand is every dime that the government spends must be paid for by the public, one way or another. Now, the traditional way to pay for it is with taxes. The government wants to spend money on the military. They want to spend money on Social Security or Medicare or whatever they're doing. They need to collect taxes because the government doesn't have any real money because the government doesn't really produce anything. It only has the money it takes from the private sector, and then it takes that money from one person and gives it to somebody else. They have to take it first. Well, if they don't take it through taxation, how do they get it? They print it. They sell bonds to the Federal Reserve. The Federal Reserve buys those bonds and puts money into the government's checking account, and then the government just spends that. But when the government spends that money, what it does is it reduces the value of the money that already exists. So everybody's paycheck is diminished in value. Everybody's savings are diminished because now prices go up because you have more money in the economy without new production to give that new money value. That increase in price that is a result of this deficit spending and money printing is basically a tax. But the people don't realize they've been taxed. So the politicians love it because they can pretend that the voter's getting something for nothing because the voter doesn't make the connection between the price hikes. And if the economy is really booming so that prices are dropping, you don't even notice the price hikes. But now the problem is we've created so much money, especially after COVID and all the money we printed there, which was, off the charts crazy during those years. We now have so much money in the pipeline. The economy is now being crippled by more regulation and other things that are making it less productive. We're seeing much greater upward pressure on prices. But I tried to make the point earlier is that we would have even seen more movement in the CPI earlier if it wasn't rigged. The CPI we had in the 70s is not the same CPI we have now because in the 1990s, they changed it all. They changed the methodology for computing price increases. Their goal was to have a lower CPI because they claimed that the CPI was overstating inflation. And so they decided to fix it. If you measured the prices that we saw, the increases, if you used the 1970s CPI and then took the prices that we were living through, they were double digit. I mean, we were probably the year that we had 9%, it was probably 18%. That was worse than any year of the 1970s or early 1980s. That's how bad it was. Shadow stats, they've been doing that for a long time. When they changed that, back in the 70s, it was the same basket, and they just said, what did it cost last year, and what does all that exact same stuff cost this year? But now they don't do that. They change the basket. They take stuff out that's gone up. They put stuff in that didn't go up as much. They adjust it for so-called quality improvements. Oh, that's a much higher quality than the one you bought last year, so let's make the price go down. But it's subjective. Is it really better? And a lot of times the quality goes down. I don't think they ever subtract for falling quality. It's like a one-way street. They just assume everything is getting better, when in many cases, people are substituting lower quality ingredients or stuff that used to be included. A classic would be airline. People would buy an airline ticket. They got their seat. They could get food. They could get a pillow. They could get a blanket. They could carry on stuff. Now, all of a sudden, all that's extra. It's not part of the airfare anymore. You want to pick your own seat? That's extra. You want to check luggage? That's extra. You want a blanket? That costs more, right? All this stuff now are add-ons. That's not part of the CPI. If you look at some of the other measures, like where the government uses personal consumption expenditures, there you have lots of hedonics where they just basically say, oh, if steak gets too expensive, we'll just kick out steak and we'll put hamburger in there because we'll just assume people stop eating steak and they settle for hamburger. We can pretend that the price didn't go up. But the quality is going down. I want to eat steak. I can't afford it. And so I'm stuck with hamburger. And according to the government, that means there's no inflation. I mean, by that logic, if I have to give up hamburger and start eating dog food because I can't afford hamburger anymore, as far as the government's concerned, there's no problem because I'm still eating. But I don't like having to eat dog food. I'd rather eat people food. But this is how the whole thing is rigged. They're taxing us through inflation. Then they're lying to us about how bad it is. And the ultimate irony is all the years that the Fed was printing all this money, creating all this inflation, they were pointing to a rigged CPI that was less than 2%. And they said, we need it higher. We don't have enough inflation. And that was the justification for continuously creating more inflation because they theoretically said we need to get up to 2%, when in reality, we were already way above 2%. But there's nothing magical about 2%. 1% is better than 2%. If you have 1%, you don't try to get up to 2%. You try to go down to 0 or -1. Lower prices are better than rising prices. Only an idiot economist or a central banker, or maybe some of these Wall Street people, could believe that rising prices are good, or that prices that go up by 2% every year constitute price stability. That's not stability. That's a continuous increase in price. Stable means the prices don't change.
Why is it a fallacy to believe that if prices are going down, that people just turn into Scrooge McDuck, storing their money away and freezing up the economy?
First of all, the fact that we have an economy that is based on spending, that's the problem. That's part of the bubble. We have a bubble economy. A legitimate economy would not be based on spending. It would be based on savings and production. You don't have to encourage people to spend. Everybody wants to spend. I mean, that's how we ratify ourselves. We want things. Everybody wants stuff. And so everybody would spend. I mean, I have young kids. I mean, they would spend constantly if I didn't stop them. I mean, they don't need encouragement. I mean, I have a wife. I don't have to encourage her to spend. I got to do everything I can to stop it, right? So spending doesn't have to be encouraged, right? Because that's delayed gratification. Savings needs to be encouraged. Do without what you want. Don't have it right now. Wait, delay your gratification. So you need to encourage that. And the market does that with interest and other ways of rewarding people for saving. But when interest rates were at zero and inflation was above zero, we were punishing people for saving. We were punishing people for doing exactly what they need to do. Because what makes a real economy grow is savings, because savings is what finances capital investment. Capital investment is what leads to increasing productivity and higher living standards. Everybody wants to buy. That just comes naturally. We all want stuff, so we don't need to encourage that. But the idea that if prices fall, that people will stop spending and therefore prices need to rise to encourage spending is pure BS. People are going to spend anyway, but they're actually more likely to spend if prices are going down than if prices are going up. And here's why. This nonsense that if I think the price is going to go down, I'm just not going to buy it. I'm going to wait to get it cheaper. Therefore, no one's going to buy because we're all going to be sitting back waiting for a better deal. That is nonsense. People buy things when they want them. And the proof of that is all around us. Cell phones. The first cell phone was probably $2,000-$3,000 when you finally got a portable phone. And it was very expensive to use it. When I finally got my first cell phone, I never wanted to use it because it was too expensive. I would say, hey, call me on the weekend. I can't talk. I'm on my cell phone. It's too expensive, right? But the reason a lot of people didn't buy the first cell phones is because they were too expensive. They couldn't afford it. The reason everybody has cell phones now is because they're so cheap. The price going down is what motivated more people to buy. You buy things when you can afford them. And if you can't afford the current price, if the price just goes up, well, then you really can't afford it. The first television set probably cost the same as an automobile. Who bought the first television set? Some really rich guy. It was a novelty, but it was a gigantic piece of furniture with like a 2-inch screen, and you probably had 2 channels, and you had 2 or 3 hours a day where you could watch it. People bought televisions because they got cheaper. Now, people buy televisions all the time. Everybody knows if I buy a television today, a year from now, I could buy a better one for less money. Everybody knows that, but they buy them anyway. The same thing with a computer. Every piece of electronics that you buy, if you just don't buy it and buy it in a year or two, you'll get it cheaper. But people buy them anyway because they want to use them now. If you own a business and you really want to incentivize people to come in and shop, what do? You have a sale. You lower the price. Hey, I'm lowering the price, 10% off, 20% off. Now people, they want to shop. Like, why does everybody come to the stores on Black Friday? Because they lower the price, because they raise the price. So it's just complete BS that people will stop spending if prices go down. No. They'll spend more because they can afford to buy more. They'll buy more stuff at lower prices. When you're talking about costs causing inflation. And the same thing as prices. Sometimes they say costs go up and that makes prices go up. They talk about the cost price push. But costs and prices are 2 words for the same thing. One person's cost is another person's price. If I'm a business and I have to buy steel, well, what's my steel cost? Well, the guy that's selling me steel, my cost is the price he charges me. It's his price. It's my cost. So prices and costs are really the same thing. Why are they going up? What's making them go up when a free market would make them come down? That is the beauty of capitalism, is it lowers costs.
How does it lower costs? Is it through innovation or is there another mechanism?
Yeah, through increasing productivity. I figure out cheaper ways to make stuff. You build a more productive mousetrap so that you can catch more mice for less money. The cost of producing a cell phone today is much lower than it was 20 years ago. That's the reason they're so much cheaper. The free market figured out a better way to produce. And they did that because the companies earn money from selling some very expensive cell phones. They take that money, they invest in research and development to figure out more efficient ways to produce. And of course, as they produce more at lower prices, they also create economies of scale. That is the natural tendency of a market-based economy. If you look at the US, if you look at the CPI in 1900, and then you look at it in 1800, 100 years earlier, prices are down about 50%. Prices are half that they were in 1800. The market cut cost of living in half. We were on a gold standard for most of that time period, other than a few years of the Civil War, where we really started printing money. But in that economy, prices went down. Now, with technology, we should actually be enjoying even faster price declines in this century than they had in the 19th century. The reason we've been robbed of those benefits is because of government. And of course, there is a lot more regulation now. The markets are not as free as they used to be, and therefore they're not as efficient as they used to be. And therefore prices aren't going down as much as they would if the government got out of the way and allowed entrepreneurs to be more effective. Instead of having to waste resources and time on government red tape, they could have devoted those resources to becoming more productive. But there was another reason, too, that they were able to keep the inflation rate low, is we outsourced all of our production to China. we had all these Chinese workers that would do the work for a fraction of what Americans would in factories that didn't have to deal with all the regulations of American factories. And so we got all this stuff coming in from China that helped keep prices down. But the flip side of that was we lost a lot of good paying jobs and we ran massive trade deficits. Now we have to deal with that problem that we created trying to kick the can down the road, because you're right about politicians and their time horizon. They can only see as far as their own reelection, which in America, in many cases, is 2 years. People want something for nothing. That is the inherent flaw of a democracy. That's why the founding fathers established America as a republic, not a democracy. And they tried to protect the country from the evil forces of democracy, which they refer to as mobocracy. So we're not supposed to be a democracy for the very reasons that democracies create the type of problems that we now have. Everything that you're happy the government did was a mistake. Now, the reason you're happy they did it was because of the short-term benefit of that mistake. But you don't perceive the actual long-term consequences of doing that. Let's say you're a football player, you're in a game, you injure your ankle, and the coach is like, look, let me shoot you up with this so you can keep on playing because we want you in the game. And so he shoots you up with this medicine and you don't feel the pain. And so you keep running on your foot and you're able to finish that game. But because you did that, you screwed up your foot so bad, you're out for the rest of the season. They were just thinking about one game. And so you ran on a foot that you shouldn't have run on. You got numb to the pain. And your body was like, hey, don't run on me. Go rest. That's what the government does. They try to make us numb to the pain, and then we end up doing more damage. And so what happened after COVID, that policy was horrific. And bailing out the banks, both in 2008 and now again with the bank bailouts we've had this year, all this is a mistake. The politicians want to get reelected, right? They just want to win this game. They don't care about the season. It's this game. And so they're just doing whatever they can to numb us all to the pain. You know, there's a saying, you talk about a free lunch, that there's no such thing as a free lunch. And that's because somebody's got to pay for that lunch. So if it's free to you, the question is, who's paying for it? Because the food didn't just magically appear. There is a cost. The government can print money, but it can't print stuff. The stuff has to be made. And that's why when you print money without any stuff being made, all that happens is the price of that stuff goes up. Because if we could just print money and people could buy stuff, everybody would be rich. We just print up a bunch of money. Why not give everybody millions of dollars and we all be rich, right? No, the price of everything would just go up. Nobody would be rich. The only way we can all be richer is if we all produce more. Printing more money doesn't change anything. You know, you're rearranging the deck chairs on the Titanic. You need a more stable boat. So we need to make more stuff. That's how we can satisfy more demand, is by creating more supply. If we just print money, we increase demand, supply is the same. Prices go up. That's the inflation. But yes, what we were able to do is we were able to con the whole world, the Chinese and a lot of other people, into taking the paper that we print for the stuff they produce, because the dollar is the reserve currency. So instead of actually having to make stuff that the Chinese wanted, we just printed money and said, hey, take this. And now they took all this stuff that they made in factories. They actually had to invest in them, and people had to do hard work, and maybe they were making pollution, whatever. But the Chinese economy expended real resources to produce all kinds of goods that are filling up the shelves in Walmart that Americans are driving home in their big SUVs. And what are they doing? How are we earning all this stuff? The Fed's just printing money and handing it out. What does that cost us? Next to nothing. In the short run, this is a great deal for Americans because we get something for nothing, and the Chinese get nothing for something, except they don't realize they're getting nothing. They think this paper has a lot of value. In reality, it doesn't, because it's an IOU. It's a claim on U.S. production. But what if our production is going down? Eventually, we're going to wipe all that out with massive inflation when the world doesn't want our dollars anymore, and they try to cash them in. When they try to buy stuff, it's like, well, what are you going to buy? We don't have our factories anymore. They're all in China. That money's no good. I mean, we run this giant Ponzi scheme. We have a $33 trillion national debt that continues to grow trillions of dollars a year. And we finance it like Bernie Madoff did, because we can't pay anybody back. So whenever a bond matures, we find some other sucker to buy it. And when we have to pay our interest, we find suckers to loan us that money too. But this only continues as long as the suckers are willing to keep lending. But when people want their money back, we don't have it. During the debt crisis, we even admitted that we said if we can't go deeper into debt, we're going to default because we're broke. So all this is going to collapse. The dollar is going to lose its reserve currency status. And then if Americans want to consume, they're going to have to produce. And that's much harder than printing. And that's going to mean a lot of people who are not productive are going to have to start working. And a lot of people who have jobs, they have non-productive jobs. Those jobs aren't going to cut it in a society where we're no longer creating the reserve currency. They're going to have to go make something. They're going to have to go make something. They're going to have to go make something.